Hello to all my dear students. I am Padmini Vasant. In this session, we shall discuss about tax planning. So what is tax planning? Tax planning is a process of analyzing a financial plan or a situation from the tax perspective. The objective of tax planning is to make sure there is tax efficiency. With the help of tax planning, one can ensure that all elements of a financial plan can function together with maximum tax efficiency. Tax planning is a sufficient and most important component of a financial plan. Reducing tax liability and increasing the ability to make contributions towards retirement plans are critical for success. Tax planning comprises of various considerations such as size, time of income, time of purchase, etc. Also, the chosen investments and the various retirement plans should go hand in hand with the tax filing status as well as the deductions in order to create the best possible outcome. How many kinds of tax planning are there? One can say 3, namely purposive tax planning, permissive tax planning, long range and short range tax planning. So what is short range and long range tax planning? The tax planning which is made every year to arrive at specific or limited objective. Conversely, long range tax planning is such practice where the assessee is no need to pay every year. So this is meant for a longer period of time. Permissive tax planning is allowed within the taxation laws, and purposive tax planning is which is to mislead the law. You can say it is tax evasion also. How can one do so? So there are some deductions and exemptions which are allowed by the Income Tax Act. So exemptions means with respect to an income which is exempt from tax. Exempted income can be partially exempt or fully exempt. Deductions are the items which are allowed when an assessee undertakes a particular activity like saving or taking housing loan. Most of the deductions are under section 80C, that is chapter 6A of Income Tax Act. So if you look at the sum of the deduction, say for the salaried employee, he can take many deductions under section 80C, that is up to 1.5 lakhs. Even can contribute to National Pension Scheme, health insurance under 80D, get a deduction on rent, and also can claim deduction on principal under section 80C. Otherwise, he can also claim under section 16 for salary, income from savings account under section 80 TTA, that is interest income, and under section 80G that is towards charity. So the best funds available, that is a tax saving instrument, is with respect to following discussion. Say for example ELSS, Equity Linked Savings Scheme Funds. So one can see that high returns and liquidity are the plus points, but they carry lot of risk. ULIPs are the second one. Similarly, you have NPS, PPF, etc. So these are some of the schemes in which the tax can be saved. So looking at the broader perspective, under section 80C you have all the investments which you can do and take the deduction. Under section 80CCC you have insurance premium paid and deduction. 80CCD you have pension contribution and claim deduction. 80TTA is towards interest on savings account. 80GG is towards house rent paid. 80E deductions are allowed on interest on education loan. 80EE is interest on home loan. 80CCG is under RGESS. 80D is with respect to medical insurance. 80DD is deduction is allowed for disabled dependent. 80DDB for medical expenditure. 80U deduction for physical disability. 80G for any donation towards charitable institutions. 80GGB is towards company contribution. 80GGC contribution to political parties. And 80RRB is royalty of a patent. And last, 80TTB is deduction on interest income for senior citizens. So these are some of the deductions under which one can do tax planning. So if you observe, tax planning involves a methodical calculation of your income and expenses and planning with respect to arriving at the best possible availment of deductions as described and permitted under Income Tax Act. That's all for today, dear students. We shall see you soon again.